So you're thinking about retirement and all those beautiful countries you want to go and visit with your friends and family, and all those fast luxury sports cars you want to drive. You may have already started looking for some products and investment strategies to get to your dream. The simple solution for you, however, is to invest in a professionally managed hedge fund. My name is Trey Zachariah. I'm a student at Algonquin College studying business administration with a concentration in finance. And the topic for discussion today is hedge funds. Now, you may be wondering why I'm suggesting hedge funds. Hedge funds are specifically made for rich people, more specifically, accredited investors, which basically means alone or with a spouse, you own financial assets with an aggregate realizable value that exceeds $1 million. Hedge funds are actively managed. This basically means that hedge funds are always being watched by a professional portfolio manager or by a team of professionals and analysts in order to beat the market's return. The phrase absolute returns is a terminology directly used by hedge funds. In addition to my previous statement, the portfolio manager's job is to create positive returns even during economic slowdowns and recessions, such as the slowdown we are now facing today in early 2020. This is important for you as an investor to understand because when it comes time for you to withdraw those funds from the account and retire, the uncertainty that the market at that particular time will be in a recession or an expansion phase is almost impossible to foresee. With a hedge fund, however, you are diversified and you can still generate positive returns even during an economic downturn in the market. So when it comes to closing your fund, you can still close your account with a positive number. However, hedge funds can use other investment strategies that mutual funds can't. Some of these complex investment strategies that hedge funds can use to make their absolute returns are as follows. They can use leverage, they can use derivatives, they can use short selling techniques, and they can use arbitrage in order to generate larger returns than, say, a mutual fund. So hedge funds, they can use leveraging to make a profit as well. This basically means that the hedge fund will borrow capital from a financial institution and use that capital to invest it into securities and then sell them when they appreciate. They then pay off any of the interest that accumulated from that borrowed money, and whatever's left over is the positive return that they made for you using leverage. Hedge funds can still use derivatives to hedge their positions on purchasing certain companies. They can short sell when the market is feeling bearish, like it is right now. And they can also use arbitrage to make profit in exchange lag between two exchanges. These are what make a hedge fund stand out from a mutual fund because mutual funds cannot use any of these investment strategies where hedge funds can. When it comes to paying taxes for your hedge fund, they are typically taxed annually, but they can also be tax deferred depending on what the fund specifically invests in. Being taxed annually is when the fund generates income from, say, selling a stock or interest on a bond during that given year. Funds can also be tax deferred if they're using offshore structures. This basically means that if the strategies of investing abroad are complicated, they can be deferred, but they are still taxed in that particular year that they were originally purchased at. Now, when it comes to paying fees for a hedge fund, they tend to have higher management fees than, say, a mutual fund, for example. Even though both funds are actively managed, the hedge fund uses more complicated investment strategies than a mutual fund, so you're going to pay a little bit more when it comes to paying for fees. Now, some of these fees are very similar to the MER, such as the administrative fees or management fees. Now, some fees that are included in hedge funds but not in mutual funds are additional fees such as the incentive fee, the high watermark, and the hurdle rate as well. So when it comes to talking about the incentive fee in a hedge fund, you need to understand that both the high watermark and the hurdle rate are closely related to the incentive fee. So basically, the incentive fee is completely based on the performance of the fund. This is determined by the fund manager, at which if earnings are exceeded in that particular year, then the manager is paid the incentive fee based on the high watermark or the hurdle rate, which I will get into momentarily. So when you hear the term high watermark, it's basically a target that is set by the fund manager, at which if the earnings exceed that target, then the fund manager will receive the incentive fee, like I said earlier. So it's completely based on the NAV PU, which is net asset value per unit. I'll use NAV PU for short. So I'll give you a quick little example of how a high watermark will be applicable to the incentive fee using NAV PU. So let's say this hedge fund that you're going to invest in right now, it's $10 per each unit. So the NAV PU is $10. Let's say after the first year has gone by, the fund appreciated 20%, so it's at $12 NAV PU. So the incentive fee will be paid on the 20% that was just earned because it was positive 20%. So the incentive fee is based on the 20% return for the fund manager. Now let's say another year goes by, so year 2 now, the NAV PU of the fund drops down to $11 per unit. There won't be any incentive fee coming out of that particular year because the NAV PU hasn't appreciated over the $12 high watermark that was previously set from year 1. And finally, I'll speak about the hurdle rate. So the hurdle rate is the rate at which the hedge fund must earn before the manager is paid the incentive fee. It's very similar to the high watermark. However, the hurdle rate is typically based off short-term interest rates. Again, I'll show you a quick example here. So let's say a fund has a 5% hurdle rate. So that basically means that the hedge fund must earn more than 5% before the fund manager gets paid the incentive fee. So let's say, 5% is the hurdle rate. Let's say it made 20% that year. So the incentive fee is based off of the 15% return between 5% and the 20% return. With all that being said, hedge funds are designed for accredited investors looking for diversification and absolute returns even during economic slowdowns or recessions. They have many fees attached to them due to their funds using complex investment strategies and for having the professional portfolio manager managing your fund. So hedge funds are great investment products as long as you have the money to get into one, and they are definitely one of the most sought after investment products for the wealthy. Hopefully you enjoyed my explanation of hedge funds and how they work, and you feel a little more knowledgeable on the subject. Once again, my name is Trey Zachariah, and thank you so much for listening.